Hey guys, in this video we're going to talk about real talk about what exactly is about to happen with the trade deal. The bottom line is this: today is October 7th, 2019, and tomorrow when you wake up on October 8th, the market will be down and will continue to go down through the rest of the week. It's as simple as that. So if you're wondering, well, Leonardo, here you are with another bearish projections of yours. I mean, have you ever been a bull, Leonardo? As a matter of fact, yes, we have. We've posted plenty of videos when we're bullish in the market, and it is just not the time to do so right now. In this video, I'll actually let you guys in on the very important secret. There are two possible outcomes for the trade deal, and I promise you, it is not what you think. Here are the two outcomes: no deal or no deal. I know it sounds a little weird, but the history points to a high probability of no deal, guys. And when we study the charts, it says here 7 charts telling you there will be no trade deal. It actually quite a few more. I think I got about 11 or 13 charts in here. So in this video, we're going to examine these charts that point to the fact that there's actually going to be no trade deal. So chart number 1, copper. Weekly chart of copper as of October 7th, at the close of the market, we got a situation of a death cross. Copper, as pointed out in our prior videos over the last year, it's a good indication, good economic indication of what is actually happening, especially when we're talking about the economy in China, which is the largest consumer of copper. So if copper is going lower, and feel free to look for the videos on our channel. We've been following these charts pretty thoroughly. When copper was at 330, we said it was going to drop. When copper was right here, making its way higher at about 310, we said it was going to drop. When copper was making its way higher right here, we said copper was going to drop. When it got up here, we said it was going to drop. So the strategy, if you look at the copper chart, it's a great representation of what's happening worldwide with most of the economies, with the exception maybe of a couple. So this is a good representation of what the world is doing and where the world is heading. When we take a look at this chart, we're definitely heading into a crash represented by this death hook so far. Now death hooks, they result in death crosses, so very much in play, can close to a further drop in the price of copper. Considering if there was a trade deal, that would be a positive for the price of copper. And as bearish as this copper chart is, it actually tells us there will be no trade deal. Pretty nice and simple. Now, soybeans. Leonardo, are you losing your mind? Are you really going to show us the chart of soybeans? What the hell do soybeans got with a trade deal? Well, and that's actually exactly the reason why this chart is also an indication that Donald Trump will not win the election next year. Now, this is not a channel to talk about politics, but just since we are trying to make projections based on what the market will do next, this is kind of a two-sided coin here. Number one, short term, soybean prices are going to drop, which represented in this chart divergence right here. As you can see, recently prices of soybeans skyrocketed from 840 all the way to 884 today, creating this bearish black candle formation. Now please notice this thing on the chart. You see how the volume's been going pretty nicely around this chart overall, but recently when we made that substantial move from 840 to 884, 890 level today, there is no volume. Basically, this right here tells you the great deal of confidence that soybean traders have in the trade deal actually taking place. In other words, they have pretty much, since there is almost zero volume here, this is how much their level of confidence is. It's pretty close to a damn zero in the trade deal. So in other words, this spike in soybean prices is very much artificial and it's not going to be sustainable. So we're expecting a huge drop in soybean prices at some point this week. Feel free to visit stockcharts.com. I'm recording this on October 7th, so basically soybeans are going down. The reason this would be important for the Donald Trump election next year, the entire Midwest in the United States has been, harmed by the trade tariffs. China used to be the largest consumer of soybeans from the United States. It is no longer the case. It's hurting the farmers Trump is trying to subsidize the farmers, but that's, I mean, that's basically, kind of like communism. Hey, we'll basically subsidize the farming community here. It's not created by artificial. It's not created by real demand. It's just government taking a little bit of money from here and transferring to the poor farmers out there. It shouldn't be so. Certainly shouldn't be so in the free economy where they should be able to make a living without government intervention. But it's actually fixed to get a lot worse once the Democrats are going to take over next year. I mean, there's really no good outcome for the farmers. They are going to be subsidized. But unfortunately, this right here, the situation with soybeans and farmers being hurt did not have to take place. It's all due to the tariff situation. If we take a look further, same thing with corn. Corn basically same idea, right? So you got a very bearish chart here. You've got a death cross situation pointing to a further drop in corn prices. Most of the corn, as you know, it comes from the Midwest here in the States. So the farmers that are producing corn, a lot of them are the same farmers that are producing the soybeans. So they've been hit basically in multiple areas. Considering the volume, this short-term spike in corn is likely to result in a drop in corn prices this week as well. Chart number 4, strong US dollar, guys. This is definitely a leading indicator of the fact that there's going to be no resolution with the trade war in China. Every time there is some kind of positive indication of a resolution, dollar actually drops. So if you look at all this situation where dollar has been dropping, it was on positive comments on the trade deal. Typically, dollar drops, strengthens the yen. But in this case, there's a great expectation that dollar will continue to rocket higher while the yen is going to drop. Basically, this chart is telling us that this is exactly what's about to happen. In other words, there's going to be no trade deal. The outcome of that will be even stronger dollar and weaker yen. And that's where we're headed. Also, this is a very cool chart because it actually tells you how to trade the earnings season that's coming up, guys. And if you're not sure how to trade the earnings, if you're not sure about how earnings correlations work, click the link below. Take advantage of our Trade Like a Rockstar course that is highly focused on trading the earnings season specifically, which is about to kickstart next week. Actually, we've got some cool companies beginning to announce earnings this week. So take that course as soon as you can so you'd be ready for a huge earnings season. Next chart, Amazon. Death cross. Actually, this one I want to combine with another chart. That chart is Shopify. I want you to look at these two charts. They're highly bearish. In one case, we got a strong head and shoulder formation, indicates a further drop. We think Shopify could actually hit a level of about 250, 260 in not so distant future. Amazon could hit a level of $1,500 in not so distant future, possibly followed by a level of about 1357. Definitely death cross formation. So if you look at all of these charts, they have one thing in common. They're either in death cross or they are in a death hook formation, which precedes some bigger drops in a particular stock or commodity. So if you guys are trying to master the charts and trying to be friends with charts and understand how to make sense out of that, and maybe you're new or maybe you've studied it but you still are not getting great results with reading charts, again, click the link below. Take advantage of the charts divergences course that we've recorded for you. But for the purpose of this video, guys, you can see anything that's bearish, like the chart of Amazon or Shopify. What these two things have in common is the fact that a lot of products that these companies sell online, they actually derive from China. In other words, they're manufactured in China. Particularly, I mean, Amazon is not a retailer, really. I mean, it helps some individual sellers bring their products to life. It's really a cloud play, so Amazon is dropping for the two reasons. The fact that, the retail sales that it's making are actually delivered by individual business owners that buy most of their merchandise in China. And the second reason Amazon is dropping, because the entire cloud sector is dropping. So all of a sudden the cloud sector is not the top favorite sector anymore, and the institutional investors are officially unloading all the cloud stocks that they have been accumulating over the course of the last few years. Shopify should suffer even more than Amazon as far as the percentage drop, because the typical model for Shopify website owners is the drop shipping model, which means they have to buy products manufactured in China, utilize shipping services to deliver them to households in the United States. So definitely the trade war in China is not favorable to anyone owning Shopify stores. And then there's clear exceptions, as people are switching their production to here in the United States or to some other places. But most of the websites that people create with Shopify, they're based on that model, ordering stuff from Alibaba website and just delivering here to the United States. So as more people understand that Shopify is going to experience some substantial slowdown in the number of websites that are going to be actually opened up. Another thing that is a definite negative for Shopify is the fact that there's just too much damn competition out there between Amazon and Shopify owners, and between strong competition. It's very difficult to find the suppliers in China that are reliable, that can deliver good products consistently in timely fashion. Clearly, trade wars make this even more challenging. Therefore, this whole business model of helping people just create a quick website, helping them launch the business, because of the amount of competition and because of the challenges associated with the trade war, this company is definitely going to take a hit in not so distant future. If we take a look at the chart of S&P 500 today, at the close of the day on October 7th, we pointed out in the video posted over the weekend and in the prior videos that this is a highly bearish chart that ultimately will resolve in a death cross. The confirmation of that today was this bearish reversal candle right here. We've got other tons of bearish things. If you're curious what they are, guys, please go ahead and watch last 10-15 videos posted on this channel that break this chart thoroughly for you. But the new development here is we pointed out that this shadow over the blue line is just a temporary thing. That move Friday was not the real deal. That move Friday was an outlier. That this move higher was ultimately going to resolve in a move lower. So far we've gotten a slight move lower, about 13-14 points drop in S&P 500. We did hit a slightly higher level, but as pointed out in the prior video, anytime we have ever gotten in the last couple of months over this blue line, which represents this magic level of 29.31, we have failed. So far we're still in a situation of this slight overshoot, which tomorrow will gap lower, and we're gonna maybe stall at this level about 29.25 and ultimately resolve lower from there. So bearish chart on S&P 500 points to the fact that the enthusiasm which we typically see going into any type of hopes of the trade deal is just not the same type of chart that we would typically observe in the overall market. So generally speaking, over the course of the last year and a half since the trade challenges began, we would see a run-up in the expectation of the trade deal. At this point, institutions are getting smarter. They understand that they could be a temporary pop, bounce, whatever you want to call it, that will result in a move lower. So at this point, we're not getting as many takers on the bullish side, but we have people being very cautious, understanding that there is high probability that there is going to be no trade deal, and it is reflected in the price of S&P futures today. And finally, VIX. VIX is destined to move higher. You don't get these bullish formations on the charts of VIX unless VIX is about to rocket higher. So what we got on the VIX today is we got in the bearish reversal candle on S&P 500. We actually got a bullish reversal candle on the VIX. So VIX is about to revisit these levels 22, 23, 25 and breakout all the way to 32 possibly by the end of the week. If you examine the 1 day 1 minute chart in S&P 500, it is clear a pyramid move 11 type formation, which you studied our 13 markets move formula course. It identifies this move 11 as a topping move type formation, indicating that the top in the market is here. So if you compare that, this would also coincide with the same type of top created today in the 1 day 1 minute chart with the oil futures. Okay, these two things had substantial correlations, which we typically do not see, but they are so incredibly positively correlated lately that pretty much every time the oil moves lower, the market moves lower. So besides the headwinds from the no deal type circumstance this week, we will see oil respond negatively to the no deal, which could fuel it to break below a key level of 51. And again, if oil breaks 51, we're going to be at 49. After 49, we're going to hit 42. Ultimately, within 6 months, oil could be at 25 bucks. So the market is set up for a nice drop, guys. Now, here's one sector I want to point out to you that is about to tank, that is actually the very move that will put this market in the final checkmate. And we've talked briefly about this situation. We've pointed out that some hedge fund managers were going to lose their job over this trade. That's right. And they're finally realizing that they actually got this trade wrong. And they're trying to correct the situation, but they're trying to do it smoothly and slowly without losing their job. And this is how it looks. Oh, Leonardo, you lost your mind. You're not talking about Apple. You're saying all these head managers that they've just been buying the hell out of Apple, they're about to lose their job? Yeah, that's exactly what's about to take place, guys, because if you study this chart of Apple, it's about to reverse and go to hell. And this bearish reversal candles right here, guys, and the divergence on our RSI, they don't lie. They tell us a good story, especially when you combine it with this huge red candles, which basically tells you that they're really selling more shares here despite of Apple almost setting a record high. All-time high in Apple was set about 232 on October 3rd last year. That is 2018. So this year it moves up here, but this is like a lonely wolf. And lonely wolves, guys, they don't survive. Lonely wolves don't survive in the stock market. So Apple might have had a rather substantial run, but you don't have all the other participants that typically move along with Apple higher. You certainly don't have Amazon going higher along with Apple. You certainly don't have Microsoft. It's been stalled out in the 130s for quite some time. You don't have your usual suspects like Google participating either. Facebook facing some major headwinds. I don't have the chart of Facebook here, but it's going to hell as well, guys. So basically, Apple is not going to be able to sustain this momentum. It is about to reverse. As a matter of fact, to our 13 Market Move daily subscribers, members, we've pointed out this trade when Apple was hitting close to this 230 level. We said short it by 230 level puts. I think it was trading about 229 and some change at the moment. Since then, it dropped a couple of bucks. So not a huge trade, but it is a highly profitable trade if you hold on to it for a few days, if you got your entry right on this one. So further, to go along with the Apple chart, what we're really saying, Apple is never our favorite trade, guys. It's just the option pricing does not work out for these 500,000% returns. But some other things will produce much better returns if you use the same analogy study in the Apple chart. Apple is about to reverse. It will take down, finally, the sector that will produce some phenomenal returns, and that is the semiconductor sector. See, institutional investors have been buying the hell out of semiconductor stocks for a while without no apparent reason, because if the world economy is slowing down, okay, they shouldn't be buying semiconductor stocks. And yet, one goofball today upgrades NVIDIA stock. And what do? We recommend our 13 Market Move daily members and the group in the chat room to short the hell out of NVIDIA when it was trading around 187. So, well, NVIDIA dropped about $3 since then. We're going to take a look at that in just a second. But the analogy is the same. All of this semiconductor stock, they're about to drop. So ASML is still a great short. Nice formed top formation right here, guys. This thing is about to reverse and head lower. 230 would be the first stopping point. 215 would be the second one. Now, a better trade would be AVGO, simply because the chart looks a lot more bearish. It's about to form this death cross. We've been so close to it in the last couple of videos. We've shared this chart, but now we're even more closer to making this bearish crossover. Once this deal crosses over, guys, look, 210, 220 area is actually not going to be very far out of reach. And similar formations, right? If you look at the tops right here, similar formations to ASML, Apple, we're talking about the same sector. It's about to dive much deeper here. Now, double top in NVIDIA was the main reason we suggested our members to actually short the hell out of this thing, while one goofy analyst was actually upgraded. Now, this is the trend and the behavior we have been observing in a lot of stocks, okay? A lot of favorite type stocks, a lot of stocks that typically a lot of head managers like because of their growth prospects, okay? And you may think, well, Leonardo, wouldn't it make sense that they're taking money out of this type of stocks and they're putting them in other sectors? And what we're saying is no, because we studied pretty much every sector out there, and they're all forming either death hooks or death crosses, which result in further drops. So we're not seeing banks actually taking money out of one sector and putting it in another sector. We're seeing unanimous selling across all sectors, and this is probably our favorite sector to short right now because it has not deteriorated yet. So the big move is about to take place. So this was our play from 187 to 184 so far. This bearish reversal candle. This thing is about to go way lower, guys, despite of the analyst upgrade. Now, with that said, okay, don't let the news trick you. And if you're trying to make sense out of these markets, guys, the charts tell you the real deal, that there is going to be no deal. Trade smart. Learn the 13 markets move formula. Click the link below, guys. I'll catch you on the next trade soon.